Welcome to the series on systematic trading. This is the sixth and the last episode in the series, and today we will talk about things which usually don't get talked about much, which is holding period, costs, and a few psychological aspects of trading. So without further ado, let's get started. So far we have spoken about how to get started with an idea and take it to a structure where it can be traded, and coded perhaps. We also spoke about market regimes and how that can impact the outcomes of a given strategy. Then we focused on position sizing, where we looked at two major types of position sizing and how it affects a strategy, whether it is an intraday strategy or a positional strategy. Now, but trading is much beyond this, is what I think. And there are things which it could be transaction costs, it could be trading psychology, it could be drawdowns, it could be a lot of those things which, which don't show up in numbers.
Yes.
Or even if they show up in numbers, it is hard to experience. So those are the nuances which, I would want to talk about here. So what I would want is, if at all we kind of structure trading into two broad buckets. One is in terms of intraday trading and positional trading. What kind of nuances usually that get, ignored, or what were those nuances that you experienced and you thought, okay, these things were not in the numbers? So I want your take on that.
Yeah, right. So the nuances that matter very much depends on what segment of the market we trade in, whether it's cash segment, future segment, option segment. There are few nuances that matter irrespective of what segment we trade in, and few segment specific nuances.
Sure.
Right. So first, let's talk about time in the market or holding period. Right. We generally hear the statement, time in the market is more important than timing the market.
Investors talk about it.
Investors talk about that. But in my opinion, it is as important for a trader as much it is for an investor. Let me explain what I mean by taking example of couple of strategies.
Sure.
Right. So the first strategy is range breakout on Nifty Futures. It is a 9:16 a.m. to 10:15 a.m. range breakout. We put a stop loss of 0.5% on the futures position, futures level. And the position sizing would be like one lot traded per 10 lakh of capital. So it's close to like 2x leverage if we consider Nifty Futures contract size to be around 18 lakh today, maybe. Right. So the exit time, what we are going to do is we sweep it right from 1 p.m. on the range breakout day to taking it all the way positional and exiting it at 9:20 a.m. next day.
Got it.
And we'll compare how the returns have been for these different exit time windows. So you see the graph that we got by backtesting it. The same entry rules, same position sizing rules, only the exit time is different. You have a 1 p.m. exit time, 1:30 p.m. and so on till 3:25 p.m. exit time intraday. And the final bar graph that you see there is for the next day 9:20 a.m. exit time. As you can see, the returns have gradually increased as the exit times have moved far away. What that essentially means is that lower your holding period, lower would be your returns expectation. You increase the holding period, you give higher chances of the trade playing out in a positive expectancy system, and you would benefit out of the holding period.
Got it.
So this is essentially one way to look at time in the market is more important than timing the market for a trader as well. Of course, as a trader, timing the entries and exits is paramount, right? Entries here we are keeping the same. The exit is something we are sweeping across different times, and this is what we observe.
But time in the market will also increase the risk, because the greater the holding period, greater the risk.
Yes, that's true. So time in the market will also increase the risk if we are taking it positionally. Right? So here, let's look at how this backtest fared in terms of max loss experience in a single day.
Sure.
Right? So compared to exiting it intraday at 3:25 p.m., if you took it to the next day 9:20 p.m., you see that returns increased to almost 27% from 20%. So now let's look at what was the max loss that was seen in a given trade if we took it to positional next day morning instead of squaring of intraday.
Sure.
This is a simplistic graph of the two scenarios, exiting it at 3:25 p.m. intraday versus taking it overnight. If you exited the trade intraday, the max loss you have incurred on a given day is close to only 2%. It is 2% because in this strategy you are risking 0.5% on the futures entry level. If it hits stop loss both sides, then you lose 1%, and you're trading it at around 2x leverage, which would mean that max loss would be 2%. Whereas if you take the trade overnight, even though your returns increased from around 20% to 27%, your max loss in a given single trade increased from what was 2% if you exited intraday, it increased to 4%. So there is always a trade-off involved with any methodology we follow. In intraday, your risk can be capped to predefined levels, and you would end up not benefiting from the overnight gaps. In positional trading, you get to benefit from the overnight gaps, but there would be those odd days when you get adverse gap and you end up losing more than what you wanted to. Right? So that's one thing. Now, specifically about time in the market, let's take another example of a different strategy.
Okay.
This one is a intraday cash segment strategy, which I personally trade. We'll not get into the exact rules of it because that's not the point here. We'll look at different parameters by which we can evaluate time in the market and its importance.
Okay.
A little bit about this strategy. As I told, it's intraday cash segment strategy. It's a price action based entry trigger strategy, and the entry triggers can be at the close of a 5-minute candle.
Got it.
So what that means is a trade could be generated at 9:20 or 9:25, 9:30 in 5-minute intervals right till the end of the day. So what you see here on the chart is essentially on the y-axis we have returns, on the x-axis we have trade entry cutoff time. Beyond what point in a day do we say that no, take no more trades?
Got it.
Right. So you see that so here while we analyze, the one thing that we need to notice is that the base for the y-axis is 13%. It's not 0%. So as you can see here, we can observe two things. The first thing is that after a point somewhere around 1:30 p.m., if any fresh trade is triggered, then the net return is degrading. What that essentially means is that the fresh trades that are triggered, they're not even covering the costs incurred. This is a net return graph. And what it also essentially implies is that there is very little time for a move to happen.
After 1:30.
Yeah, after 1:30, there's very little time for a move to happen, which obviously is going to reduce the returns expectation of those freshly triggered trades. Right? That's the first observation.
So what we are saying is, if it's an intraday strategy, even within intraday strategy, holding period matters.
Yes.
Because you need to give it enough time for the range to play out.
Yes, that's right. So irrespective of whether you are entering at 9:20 or 1:30, irrespective of whether you're exiting at 1:30 or 3 p.m., you end up paying the same transaction charges. So for the transaction charges that you will be paying, you want to
get the max out of it.
Yes, max out of it. Benefit the maximum points per trade out of it.
Got it.
So longer your trade duration intraday, better chances of you
capturing greater points.
Yes. So the second observation that you could make here is that if you keep the cutoff time at 9:20 a.m. itself, which means you trade only those trades which are generated at 9:20 a.m.
and don't take the other trades.
Yeah, and don't trade any fresh trades, right? So you get around something like 13.75% return, and if you keep taking the trades right till, let's say, something like 1:15 p.m., which is the peak. you get around 15.5% returns, right? So for the incremental trades that have been taken beyond 9:20 a.m., the incremental return is not really proportionate.
Got it.
Right? So 9:20, the trades that enter 9:20 a.m. have the highest time to play out, and so that's why you see majority of the gains come from trades that are generated very early in the day. That's the second conclusion you could make.
Got it.
Personally, I kind of keep different cutoff times for different days of the week, depending on whether it's a 0DT or a non-zero DT. Because my 0DT system is a high expectancy system for which I need to allocate maximum capital possible. What that means is that I don't want to allocate capital to other systems on that day. Right? So I would keep a trade cutoff time something like 9:30 a.m. for 0DT, and on non-zero DT days where
your capital is free, you just want to get something out of it.
Yes, yes. So when I have more capital, I would keep my trade cutoff time something like 1 p.m. and that would mean better capital utilization as well.
Got it. Got it.
Yeah. So the first aspect is time in the market. The importance of time in the market, even for a trader, even for an intraday trader.
So, Aamodh, one of the things which came out of this conversation was you said time in the market is good, and that allows for the edge to play out. That allows for greater number of points to be captured. All of that.
Yes.
But at the same time, the little that I understand, your trading style, you do a whole lot of intraday trading as well.
Yes.
So now this is not fitting in. So if positional is where the money is to be made, why should one trade intraday?
Yeah, that's a fair point. So there is this one aspect, like for the edge of a strategy to play out, it takes n number of trades.
Okay.
It's ultimately a game of large numbers.
Yeah, the law of large numbers.
Yeah, law of large numbers. The edge of a strategy, the positive expectancy that we see in backtest, plays out over, it's valid over a large sample size, not over just 10 trades.
Correct.
Nothing like that, right? So let's assume that it takes 100 trades for the edge of a strategy to play out. With positional trading, it might take 1 year for these 100 trades to be signals to be generated, which means that you can expect positive returns over 1 year duration. You can't expect positive returns every month, every quarter, month. Nothing like that, right? Whereas with the intraday trading, the trades could be generated with higher frequency, which means that these 100 trades, which needs to play out for the edge to play out, might happen within 1 month. What that would mean is that intraday trading has higher potential to generate regular income when compared with positional trading. As a full-time trader, you have bills to pay, but you also need regular income.
Okay.
So intraday trading has higher potential to provide that. It's not like every month you'll be profitable. Obviously, that's not the case. It's not a linear journey. Just that the potential of regular income is higher in intraday compared to positional.
So Aamodh, I'm a bit uncomfortable with this income thing because you know it that it cannot be technically compared with an income.
Yes.
But I do understand what you're trying to say. So when you say intraday, the law of large numbers plays out better with intraday, it's just because the number of instances are possibly more.
Yes.
So because as you said, you can have 100 trades in a month. So it's quite possible if the average, whatever expectancy is X, that X can play out in a month's time.
Yes.
Whereas that's hard for a positional strategy where the X will play out only at the end of the year.
Yes.
So in that sense, whatever your expectancy is, you can see that play out in a shorter period of time with intraday trading.
Yes, you have faster feedback. Now, if you want to fine tune your system, right, in a positional system, you may have to wait 1 year to get feedback from the market to say that your system is not good enough. But in a intraday strategy, you get that feedback quick. The feedback loop is faster, and you can fine tune things with a higher frequency.
I agree. So when I started trading, one of the reasons I used to scalp a lot at that point of time, and those were days which were pre-automation. So even learning simple things like what is a market order, what is a limit order, because you're doing it all manually. If you're doing 10 trades a day or 20 trades a day, you learn that faster rather than not doing it. I'm not recommending that we trade in that frequency, but then anything which you repeat number of times, you get a better learning out of it. I think it's the same with intraday strategy as well.
Yes, that's right. That's
Got
right.
it. Got it.
Trading is ultimately a game of self-awareness. You want to get feedback from the market. You also want to get feedback about yourself from you. How well you adapt to the strategy, whether it syncs well with your, we talked about belief system, whether it syncs well with your belief system. You want that feedback. Faster the feedback, faster you can improve.
Got it. But that reminds me, I want to ask you about how you manage drawdowns, which has both a financial impact and a psychological impact. So I know it's not easy. I don't know anyone who finds it easy, but how have you managed it?
So drawdowns are part and parcel of the game. No matter how good a strategy is, even a one expectancy system is going to hit drawdown. So when you know that something is inevitable, it makes all the more sense to plan for it upfront, right? So personally, what I do is that let's say I have n number of strategies in my portfolio. So there are two ways of handling drawdown. One is mathematically, and two is the psychological aspect behind it. I'll talk about the mathematical part first. So let's say I have n strategies in my system, and historically the max drawdown of this set of portfolio of strategies has been, let's say, 10%, right? I would do something like this. I would not give much significance to this 10% number itself, because in the past, a favorable sequence of outcomes could have played out during drawdown. What if something unfavorable happened during that phase? The max drawdown would obviously be higher, right? So you can't really take that number 10% as a golden line and make decisions based on that, be it stopping a system or anything like that. Personally, what I do is that, let's say my portfolio maximum drawdown is 10%. I'm going to take the average of the top 5 max drawdowns. Let's say it comes out to be 8%, maybe. What I would do is that, let's say my capital is 100 rupees. Then I will assume my capital today, when I'm not in drawdown, I'll assume my capital to be only 92 rupees, not 100 rupees. And when I do fixed fractional risk kind of position sizing, when I risk X percentage of my capital per trade, the X percentage will be calculated on this 92 rupees, not 100 rupees. What that essentially means is that when I start hitting drawdown from 100 rupees to 99, 98, right until 92, I have already factored in that drawdown upfront for sizing position. What that then means is that during the drawdown, when my capital goes on reducing, I need not reduce my size. I'm a big proponent of not reducing position size during drawdown, because personally what I feel is that when you reduce position sizing during drawdown, when the good sequence of outcomes later play out, you are sized lower to benefit out of it.
And it takes time for you to get out of the drawdown.
Yes, that's right. So because I don't want to size down during drawdown, I account for that drawdown upfront while sizing position. And when I recover out of drawdown, let's say my equity curve moves back to 100, 101. Now I calculate 8% down from 101.
Position size accordingly.
Yeah, and position size accordingly. So this is how I mathematically take care of drawdown. And as I told, I don't decide to stop my strategy based on historical drawdown. My personal belief is that if you're waiting for historical drawdown to get breached to stop your strategy, then you already lost it, because the funda on which you designed your system is your ideas mimicking the market conditions. So you want to observe market dynamics at play and figure out that this strategy no longer syncs well with the market and stop it beforehand.
Got it.
Right, that's my thing.
So psychologically?
Psychologically, in the game of trading, you want to risk only that amount of money which you're willing to lose. And psychologically, I risk only that amount of money which I'm willing to lose mathematically. And psychologically, I look at it like just like a computer game, right? You win points sometimes, you lose points sometimes. What is important is that you don't want that losses to affect your real life. Let's say you're in 10% drawdown, you look around, if people around you are treating you the same. They don't even know that you are in drawdown. Nothing has changed practically in your life. You're still having breakfast, the same quality of food. Why do you want to worry about it, right? So if you're trading a positive expectancy system, a good enough system, it is a given that your system is going to come out of drawdown, and you don't want to be thinking too much about it, right? Be it during drawdown or be it not during drawdown, your focus should be on understanding why a system works, so that when you are in drawdown, you are able to make a better judgment of whether the system has stopped working or is it just a phase, right?
So, so talking about drawdown, see, you are a full-time trader today. You were earlier working with a company. You don't have an income flow right now.
Yeah.
So, how did things change there? Because now drawdown has a different meaning. You don't have a salary coming in to kind of plug that back in.
Yes.
So how do you deal with that?
Yeah. So as a full-time trader, it's important to be. I've probably gotten more conservative with my position sizing and how I look at drawdown. In the sense that when I was a part-time trader, when I had the backup of a salary coming into my account, I used to trade with 100% of my net worth. Now I've taken money out of my trading account, put it somewhere else at a safe place, and I'm trading with much lesser percentage of my net worth. What this would mean is that earlier, as a full-time trader, a 10% drawdown on my trading account was 10% drawdown on my net worth. Now a 10% drawdown on my trading account is probably just a 6%, 7% drawdown on my net worth. So that's one side of things. The second side of things is that I've become more conservative in terms of reducing risk. When I say reducing risk, I'm talking more about the drawdown risk side of things, adding strategies across intraday and positional, across market segments, which is index futures, stock futures, and commodity futures, and doing intraday cash segment trading as well. So when you diversify, you tend to reduce. If you diversify well, you tend to reduce drawdown risk, right?
Yep.
So that's the thing. So handling drawdowns is actually a little tougher as a full-time trader, because obviously you don't have that income coming in from salary savings. But all you can do is whatever is in your control. Managing risk is what's in your control. You tend to manage the drawdown risk by diversifying more. Yeah, that's how I do it.
Sure. So that reminds me, because you just said you are trading multiple segments. The way Indian markets work, our transaction costs are not linear across segments.
Yes.
Okay.
Yes.
So how do you deal with that?
Yeah. So yeah, that's a good point. This is probably one of the most nuanced things when it comes to designing a strategy, right? You could generate signals on the spot. Let's talk index Nifty. You could generate signals on Nifty, and you could trade it via Nifty Futures, or you could trade it via Nifty options, right? If you take a cash segment system, if you take a stock specific system, you could generate signals on the cash segment. You could trade cash segment itself, or you could go with stock futures. You could trade with cash segment unleveraged. Obviously, you don't have leverage with the cash delivery trades, or you could trade it with MTF leverage. There are multiple ways in which you can trade a particular idea, trade a particular strategy across different market segments. And the costs associated with it are quite different, right? So it's important to understand what do transaction costs depend on and what transaction costs don't depend on, right? And before talking about that, what transaction charges are involved, right? So you have security transaction tax, which you pay to the government. You have exchange transaction tax, which you pay to the exchanges. You have brokerage, which you pay for the broker. You have SEBI turnover fees, which you pay to SEBI, the regulator. And on top of this, you also have slippage, which is essentially a charge you pay for the liquidity maker, right? And on top of this, if you are still profitable, you end up paying income tax, right? So these are the transaction charges involved. You want to be, if I talk about income tax, you got to be privileged to pay it, because it's an uphill task as a trader to overcome all these transaction charges and still be profitable if you're still profitable, that's a good thing to have. Now coming back to the topic, so transaction charges essentially depend on the turnover that you have, right? So it depends. Turnover is essentially your buy level, sell level, and quantity. That's what it is dependent on. And across different segments, the holding period, whether you take the trades intraday or positional, makes a difference. For example, in cash segment, if you take the trades intraday, the STT is much lower compared to what you would do for the same turnover if you take it positional. Let's look at a snippet from Zerodha brokerage calculator, where you get the numbers for trading across different segments.
Sure.
So as you can see, here we have the charges for intraday equity, delivery equity, and futures. The turnover is the same across all three segments. What you see is that the charges between intraday equity and delivery equity, the STT you pay for delivery equity is like almost 8 times that of intraday equity, right? So we talked about time in the market, taking trades positional if we wanted to benefit more out of a move, but it also comes at a cost of higher transaction charge, right? So when you evaluate how you want to design a system, you want to factor in the transaction charges upfront and only then make a choice, right? Now, if you compare delivery trades with futures trades, for the equivalent turnover, you still see that delivery, you still end up paying STT of 840, and in futures, it's only around 220, which is still somewhere close to 3.5x right, of the futures trades. So transaction charges is a cost of doing business you can't escape. You just have to factor in that while designing a system. So transaction charges, as I told, are the cost of doing business. You can't really escape it. You pay it for the infrastructure that you get out of various players in the game. All you can do is factor it in upfront, model that in your code in a pessimistic way, so that when you trade it live, you don't have any surprises related to them.
When you say pessimistic, you mean add more slippage than what you can expect and so on?
Yes, add more slippage, one thing. And also in this day and age, when you have STT increased across budgets, you also want to increase STT by some basis points and see how much the degradation of your system is with respect to such changes.
Got it. Yeah. Got it. Cool. So, so one last question.
Yeah.
Now, we are living in a world of social media. There's so much of news. There is so much happening every moment. Yeah. What kind of a approach that you use to track what is happening, and or do you not do that at all?
So I do track social media to get a hold of what's happening, be it in the trading world or be it in other things that happen in world that affect your trading ultimately, right? So handling noise is one of the most important things you need to master as a trader. I like to bucketize noise into two buckets. One is external noise, the other one is internal noise. The external noise is where you are scrolling on Twitter and you see that you are in a long trade, but someone has tweeted that this is the point from where market is going to reverse now. How do you handle that? Will you exit the trade just because you saw someone with big follower count, someone you respect, right? So the way I look at it is that I look at it in a very blunt way, in the sense that I ask the question, what does my backtest result depend on? It depends on the data fed to the backtest. It depends on my end-to-end exit rules. Is people's opinion an input to your backtest result? No, it's not. Is people's opinion an input to the live market price action that's happening? No, it's not. Market does not know those people exist. Market does not know even you exist, right? So when that is the case, why do you want to even consider all those things for your decision making or getting your mental framework misaligned as far as systematic trading is concerned? You could at best look at it to just keep updated related to all the trading related regulations, this, that happening, but you don't want to make decisions based on what you see on social media, right? cut out the external noise. The second thing is internal noise. Internal noise is where you speak with yourself, right? Will this system work in the future? The answer is you don't know. No one knows. There are no guarantees in the market. So thinking about these kind of things is a lower reward to risk game where you definitely don't have any answer. Even if you answer something for yourself, it's just to pacify yourself. It's not a fact, right? So you just have to just do it is what I do. You just cut it short there, let the system play out. Even if you're observing MTM and it swings, you need to have the nerve to hold through it. It's important to look, in my view, it's important to look at the MTM and order book so that you get feedback on how well your strategy is reacting to market dynamics. But beyond that, if that is raising questions about yourself and your system, simply because you have doubts, then you just need to cut it short. That's it. It's a low reward to risk game that you're playing.
Great. So that's lovely, Aamodh. I think when I think about noise, I do follow social media, and the way I process that information is when I see. And you usually get a lot of different views, right? One person will say go long, another person will say go short, or I'm going short. Whether they're going short or not, we don't know, but they're saying it. So I just consider that as fun. So that is market. So there are people who are going long, there are people going short. But when I tested, as you said, when you test your system, create your rules, you don't include all these Twitter, social media inputs. If you do, then it's a different story. But since your system does not look at all that, you just go with what the system says. And one of the things which helps me particularly is, let's say, knowing your system more and more. So the more confidence you have, the better you have backtested your system, you will have more confidence in terms of the rules that you follow, and the lower the odds that you are going to succumb to any of these noises. So that's what it is. So thank you so much for your time. And I hope all these inputs are of use to all those who are listening. Okay. And look forward to have you with us more often in the studio.
Yes. Thank you, Sandeep. It was nice having myself on this show. It's my pleasure. Yeah.
Cool. Thank you. So that brings us to the end of this 6-part series on systematic trading with Aamodh. I hope you like this series, and if you have any questions, feel free to share them in the comments and I would do my best to answer them, and see you in the next one.